Hi students, welcome back, and in this lecture I will be talking about the corporate capital. Under corporate capital I will be touching on the different components that are there. Then I will move on to the accounting for common stock issuance. Under this I will be talking about how we record for the issuance of common stock when it is done on cash. I will be talking about the recording of common stock which are no par value stocks, and then I will be talking about the recording process of the issuance of common stock which is for services or other non-cash assets. So without further delay, let us start the discussion. So at first I will be talking about the corporate capital, which can also be called stockholders' equity or shareholders' equity. So there are two primary sources of corporate capital. One is the paid-in capital and the other is the retained earnings. So paid-in capital is the total amount of cash or other assets that is paid by the stockholders to the corporation in exchange of its ownership right. The retained earnings, on the other hand, is that portion of the net income that is retained by the company for future investment in order to ensure future growth. So under the paid-in capital, there can be common stock or preferred stock. So common stock and preferred stock are recorded at its par value. However, there are instances when the issuing price of the share is higher than the par value of the stock, and in that case, the company receives some additional amount of capital in excess of the par value, and that is recorded under the paid-in capital in excess of par, and that is also part of the paid-in capital section. So this is how the owner's equity section of a balance sheet looks like. If Delta Robotics has a balance of $800,000 in common stock and $130,000 in retained earnings at the end of its first year, its stockholders' equity section is as follows. So we can see that the stockholders' equity section here has the same two headings. One is the paid-in capital, and under paid-in capital, since the company has only common stock, so only the common stock is written under the paid-in capital with an amount of $800,000, which was given in the example. And under the retained earnings, the amount is $130,000, which was given in the example. So the total stockholders' equity becomes $930,000. So this is how the stockholders' equity section of a balance sheet will look like. Here, the comparison of owner's equity account reported on a balance sheet of a proprietorship, partnership, and a corporation is given. And as you can see that in all these forms of organization, the owner's capital account has a normal balance of credit. However, in case of corporations, an additional account is also there under the owner's equity account, which is the retained earnings, and it also has a normal balance of credit. Students, I want to draw your attention here because as you have seen, only the corporations have two parts in their owner's equity account. One is the paid-in capital and the other is the retained earnings. So when we are talking about the closing entry, as you have learned in the previous chapter, that income summary accounts must be closed against the owner's capital account. However, in case of corporation, the income summary account must be closed against the retained earnings account, not the owner's capital account. And that is just because that whenever we do owner's equity statement, we actually adjust or add up the net income with the retained earnings, and if there is a net loss, then we deduct it from the retained earnings. So it must be closed against the retained earnings portion rather than the paid-in capital portion. And again, I want to make you remember that whenever there is a net income for a corporation, the income summary account must be debited in order to close it, and in case when the company incurs net loss, the income summary account must be credited in order to close it against the retained earnings account. So now let us consider an example, and it says that at the end of the first year of operation, Dorel Corporation has $750,000 of common stock and net income of $122,000. Prepare the closing entry for the net income and the stockholders' equity section at the end of the year. So here we have the closing entry which says income summary debit $122,000 to retained earnings credit of $122,000. So as it is said that there has been a net income of $122,000, that means income summary account must be debited in order to close it, and since it is a corporation, so it must be closed against the retained earnings account. So this is what has been done here. Income summary account has been debited and retained earnings account has been credited. So next we have the stockholders equity section, which definitely will have two parts. One is the paid in capital part, and under which we have written the common stock because nothing about the preferred stock is written or given in the example. So we have written paid in capital. Under paid in capital we have written only common stock of $750,000, and then under retained earnings we have written $122,000, which is the net income of the company, and the total owner's equity or stockholders equity has come to $872,000. Students, I will be starting a new section here. This is called the accounting for stock transaction, and initially I will be talking about the recording process of common stock issuance. And let me just go through the primary objectives very quickly. Here we will identify the specific sources of paid in capital and maintain the distinction between paid in capital and retained earnings. Here you'll have to remember that issuance of common stock affects only the paid in capital account, not the retained earnings part. Students, as I have discussed earlier, that par value does not indicate a stock's market price, and therefore the cash proceeds from issuing par value stocks may be equal to, greater than, or less than par value. When such issuance of common stock is recorded under the books of the corporation, it has to be recorded in two entries. One is for the amount that has been received for par value, and the other entry should be for the amount that is in excess of the par value. So let us just consider an example for that. Assume that Hydroslide Inc. issues 1,000 shares of $1 par value common stock. Prepare Hydroslide's journal entry if 1,000 shares are issued for $1 per share and 1,000 shares are issued for $5 per share. So in this case, what should be the journal entries? First of all, it is said that the 1,000 shares are issued for $1 per share. That means that there is no additional amount received by the corporation due to the issuance of 1,000 shares. So this entry will be pretty simple because it will be cash debit by 1,000 to common stock credit by 1,000. So here why we have debited cash, it's because the company has received cash due to the issuance of common stock, and when cash increases it must be debited. And common stock is a capital account, and as you know, when stock increases or capital increases it must be credited. So $1,000 has been credited in the books of the Hydroslides Inc. Next, it is said that the 1,000 shares are issued for $5 per share. However, it is also mentioned that the par value of the stock is $1. So what should be the entry here? So here again, cash should be debited by $5,000 because it is said that the stocks were issued for $5 per share. So $5 multiplied by 1,000 comes to $5,000. So then we will write common stock under the par value. So 1,000 multiplied by $1 par value, which comes to 1,000. However, since the issuance of stock was done for $5 per share, so the additional $4 apart from the par value must be recorded as the paid-in capital in excess of par value, and that must be credited. So as you can see, paid-in capital in excess of par common stock is written in the credit side, and the amount is $4,000 because it is 5,000 minus 1,000, which equals to 4,000. Here we have the stockholders' equity portion of the balance sheet of Hydro Slides. As you can see that under the paid-in capital we have common stock of $2,000 that we have just journalized at par value of $1. And then we have common stock in excess of par, which is $4,000, and these two has been journalized in the last slide. So the total paid-in capital comes to $6,000. Then we have the retained earnings portion, which is $27,000, and this is the portion of net income that was mentioned in the earlier slide. So the total stockholders' equity for Hydro Slides Inc. is $33,000. Students, here I will be discussing on how recording should be done for the issuance of no par common stock for cash. If you can remember that earlier we have said that no par common stock sometimes has a stated value, and in that case the entries are similar to those of a par value common stock. In this case, the corporation credits the stated value to common stock, and in case when the selling price is higher than the stated value, the corporation credits this excess amount to the paid-in capital in excess of stated value. So now let us consider an example. Assume that instead of $1 per value stock, Hydro Slide Inc. has $5 stated value, no par stock, and the company issues 5,000 shares at $8 per share of common stock. So first of all, let us just discuss the transaction. First of all, we understand that by this transaction, Hydro Slide has received cash of $40,000 that comes from 5,000 shares multiplied by $8, which comes to 40,000. So the cash should be debited for 40,000. So let's see. So cash we have debited for 40,000. Next, we have just said that if the company has a stated value of no par common stock, then it must be credited to the common stock account. So the next entry should be common stock credit for an amount of $5 multiplied by 5,000 shares. So it comes to 25,000. So common stock has been credited for $25,000, and this 25,000 has been derived from 5,000 shares multiplied by $5 stated value per share. Next, we get to know that the market price of the share was $8 per share. So in that case, this excess $3 per share has to be recorded, and it should be recorded under paid-in capital in excess of stated value common stock. So here you can see that we have credited the paid-in capital in excess of stated value common stock for $15,000, and this comes from 5,000 shares multiplied by the excess of $3 per share, and it comes to $15,000. So this is how a no par common stock with a stated value should be treated when the stated value is less than the market price of the share. So what happens when no par stock does not have a stated value? In that case, the corporation credits the entire proceeds to the common stock. So now let us assume again another example. Assume further that no par stock does not have a stated value and the company issues 5,000 shares at $8 per share for cash. So here, as you can understand, the entry will be pretty simple because here the company has received $40,000 because it has issued 5,000 shares and each shares were issued for $8. So 5,000 multiplied by $8 equals to 40,000. So cash should be debited for 40,000. And as you know, no stated value is mentioned here. That means the entire proceed should be considered as the common stock. So we should credit common stock for $40,000. So this is pretty straightforward. Students, we have come to the end of the discussion on the issuance of common stock and how they should be recorded. So I hope it was easy for you to understand. So hope to see you in the next lecture.